Hey everyone, welcome back to your weekly market outlook. This is for the 10th to the 14th of April 2023. Let's take a look at the market and just quickly recap on what's really going on last week. So it was a pretty quiet week last week. We've got the Easter long weekend, obviously. So very thin trading. I think that thin trading pretty much started out on Thursday and that followed through on Friday. So we don't actually see a lot of reactions coming out from the NFP numbers. But let's take a look at some of the stuff here. I want to focus a little bit more on the RBA rate decision because this is a pause from the RBA, pausing at 3.6%. This is the first pause after 10 interest rate hike consecutively. So this is actually very interesting because we have a more of a contrasting stance coming out from the RBNZ, which actually hikes by a surprise 50 basis points. This is 25 basis points higher than what the market was expecting. So with the RBA and the interest rate pause, obviously that's going to add a little bit more pressure into the Aussie USD, into the downward pressure on the Aussie USD here. But if we take a look at the Aussie USD, the reason why they paused their interest rate, it's really more on taking a little bit of a pause and see what the data for the upcoming month is going to be, because they don't really want to tighten too much. Otherwise, the Australian economy, which domestically it has pretty much slowed down significantly, and we also have falling house prices in Australia as well. So I think those are going to be the consideration, as well as what's been going on with the banking crisis, or not really a crisis, but it really was the issue pretty much the past month, and more. I guess with the RBA pausing, because I think all the banks in Australia, it's really gonna tighten up in terms of how easy to get lending from the banks. So it could lead to a little bit more of a credit crunch. So there's a little bit of a pause going on here, and from words from with my conversation with other analysts in Australia, it's that there's likely going to be a pause that's going to be ongoing until July or August 2023. So it is going to be a little bit of a little wait and see for the RBA. So that's actually going to put a lot of pressure on to the Aussie USD, especially with the RBNZ doing a surprise rate hikes this week as well. Okay, so that's something to discuss with the RBA, and we are going to take a look at the Aussie USD later on, and it's pretty much in line with what we have been warning for the past 2 weeks, that it is in a bearish flag. It's overall within a downtrend. So I think we have seen that breakout happening last week. And also with the US numbers, we want to focus a little bit more on the ISM manufacturing PMI, because the flash PMI was a little bit higher. It was at 49. The ISM manufacturing PMI, which is kind of like the final PMI numbers, it's come in at 46.3. This is lower than what the market was expecting, which is 47.5. And if we take a look at the ISM services PMI, this is also a little bit lower at 51.2. Expectation was at 54.3. So services is still alright, it's still above 50, but with the manufacturing number, I know we're looking at a kind of a really bad number. But if we take everything into consideration in terms of the US economy, the manufacturing part of the economy, that's really about 30% of the economy. So 70% is actually focused on the services. So we, in terms of whether or not this number is actually really bad, overall, if it's below 50, we would consider them to be, there's no growth in that manufacturing sector. But in terms of services, it's still okay. It's still about 50, although we get a lower number. I think the biggest surprise last week was actually the JOLTS number. But let me just clarify a little bit about the JOLTS number, because a lot of people got it wrong. So previous month's number was actually 10.56, right? And for your information, the JOLTS job openings number, which is new jobs that's being listed in the US, it hasn't gone down below 10 million ever since May 2021. So the drop below that 10 million was pretty much shocking, I guess, to a lot of people. But let me just clarify a few things. This number that we're looking at is actually the February number, and past February, obviously we have the March number from the NFP numbers last week, so we actually have a different picture. So the JOLTS number, it was a little bit of a shock. Now there are a few factors on why this would be the case. I think it would be more on, hey, there's nothing much going on in the market, it's going to be an Easter holiday. I think people are just looking for any excuses to kind of create a little bit of volatility in the market. And the market did get that volatility because we have seen that spike, especially in gold. But if you take a look at the numbers, it is a drop below 10 million. Is the drop significant? It's okay. All right, it's not really off by a lot. It's actually at 9.93 million. But the consideration is this: we have an unemployment rate that's at 40-year low for the US. I think in terms of new jobs being created all the time, I think it's normal that we see the JOLTS job opening numbers decreases as the unemployment gets better, right? And we have seen that improvement with the NFP numbers. It is above expectation. The previous month was revised up to 326,000. This month's number was 236,000. The expectation was only just 228. And we also have the unemployment rate, which kind of dropped back down to 3.5% from 3.6%. I think this is more of a realistic figure because last month we got a surprise jump of 0.2% from 3.4 to 3.6%. So I think this month's number is more of a normalization. So despite all the panic with what's going on in the market, the run to safe haven, because people are just getting really panicking that the U.S. economy might crash. It might not have a soft landing. The FOMC is over tightening and stuff like that. I think it's pretty much in line with what the FOMC wants to do. I think what we're doing is what we're looking at is the economy slowing down, and this is part of bringing inflation down. So I think this is still on track with what the FOMC is doing. Now the argument for what the market is thinking right now is whether or not there's going to be an interest rate hike in May. So I think there's going to be a 25 basis points hike in May. I'm not really expecting a 50 basis points hike, and I'm not really expecting the FOMC not to do anything either in May. So we still do anticipate that interest rate hikes. That's pretty much it. So with the data last week, I'm taking a little bit of a longer time to explain a lot of things here because it might get a little bit confusing because we started the week with a weaker numbers, that kind of really pushes up the other currencies against the US dollar. But towards the end of the week, it's just that it's NFP on a Good Friday, so pretty much all the markets, major markets, are closed, and we don't get to see a lot of volatility. Market was pretty much very thin. We saw a little bit of an initial reaction of the US dollar getting stronger, but that was immediately, it kind of fizzles out immediately within the hour as well during the NFP release. All right. So starting the week, yesterday it was still a public holiday for a lot of countries except for the US. The US started yesterday, but the Eurozone, the UK, Australia, New Zealand, Switzerland, even Hong Kong, they still have Easter Monday. So the market was still pretty quiet, right? The market is really poised for a breakout, especially we've got a very thin trading, and then on Wednesday, we're going to get the US CPI numbers. Obviously, a lot of people are going to focus on the US CPI numbers. Obviously, this is something that's going to move the market significantly. There are a few considerations to take a look at. If we take a look at the headline CPI numbers or the year-on-year CPI numbers, the expectation is for a drop from 6% to 5.2%. We might not get 5.2%. We might actually get maybe somewhere around 5.5%. If that's going to be the case, that's going to create a case for a stronger US dollar as well, which we will take a look at the technical side of things later on. Core CPI is also expected to stay flat at 5.5%, potentially jump up a little bit to 5.6%. So we might actually get that scenario where we might actually look at the headline CPI not falling as quickly as what the market is expecting. Obviously, things can change, right? The numbers could be lower than 5%. If the number is lower than 5%, then the market will create a scenario where they thought they might be thinking, hey, you know what, the inflation is falling down really quickly. We might actually think the FOMC could stop or pause the interest rate hike in May. But that could be one case scenario. So that could weaken the US dollar significantly if the market is going in that direction. But I think for the inflation to come down that low, that would be really more of a surprise outcome. I'm leaning more towards, either we're gonna get 5.2% exactly as a consensus, or we might actually get a higher inflation number at about 5.5% on the headline CPI number. So again, this is something to keep an eye out for. Also on Wednesday, we have the Canadian interest rate decision. They are likely going to pause, despite the inflation not really falling as quickly as possible. But they are likely going to follow suit with what the RBA is doing. They might actually pause at 4.5% and then reassess the situation. So the expectation for Canada is for an interest rate pause. Obviously, we have the press conference as well, and this is probably something that I would focus on. I normally kind of ignore what the Bank of Canada is doing, but for this one here, we really want to see what the reason is for the Bank of Canada to come to a conclusion that they might actually pause at 4.5%. All right, following that, depending on where you're from, it would be Thursday morning, it could be Wednesday afternoon, depending on where you're from, or Wednesday evening. But the FOMC meeting minutes is going to get released 5 hours after the CPI numbers gets released, right? So be mindful of this, because we might actually get an initial reaction on the CPI numbers, and then we could actually, if some information get left behind, for example, if the CPI numbers was higher and then the FOMC meeting minutes came in and they might sound a little bit dovish, something that was probably not telegraphed during the press conference, then it could actually reverse what the CPI reaction was. So be very mindful on Wednesday. Right, if you have any running positions, just keep in mind it's not just done after the CPI numbers. We definitely want to see what the FOMC meeting minutes as well. I don't really expect anything new coming out from the FOMC meeting minutes. I don't think there's actually much the FOMC can do. In terms of the dot plot, we already know where they're going to be going. In terms of how far the interest rate could go, it's kind of limited to just 125 basis points hike, and then they might pause. So to me, I don't think there's going to be a huge surprise. But again, if we take a look at the initial reaction in the market, a lot of people are probably not informed of this and, kind of scalp the market. They might actually move the market a little bit. So there's going to be extreme volatility, I would say, on Wednesday to Thursday, depending on where you're from. And then from Australia, we've got the employment numbers. Unemployment rate is expected to go up from 3.5% to 3.6%. On Thursday as well, we've got the PPI numbers. Normally we have a little bit of a distance, but this one here, we've got CPI and PPI pretty much next to each other. So CPI is obviously from the consumer side. PPI is going to be from the producer's price. So this is again another inflation indicator that needs to be watched for, as well as the UK GDP numbers coming out on Thursday. On Friday, we got the US retail sales number, but that pretty much wraps up the week. So the main focus would be on the CPI side of things. All right, so sorry I spent too long talking about the condition on the economy, but let's just jump into the technicals. We can take a look at the dollar index here. So a few interesting developments on the dollar index. If we take a look at the January low, where price was the index was traded slightly below 101.50 to 101. In terms of where the stochastics was actually 13 periods below that 20 level, and we measured that the same way with the current bounce up. We have transitioned back above 20, and again the length of time the stochastics remain below 20, it's exactly at 13 periods. So in terms of the dollar index, we are anticipating a little bit of a correction in the US dollar. Obviously, there's going to be limits, right? We're going to be looking at 103 as a limit, up to about 103.50 as a potential move on how far the dollar index could go. But the anticipation ahead of the CPI number points to a potential correction on the US dollar, and this is going to get reflected in all the other currency majors. Probably the weakest one would be the Aussie USD. If you rewatch the outlook last week, we're still monitoring the flag here. We have that break below the flag pretty much about Wednesday last week. That pretty much triggers a lot of sell in the market. So the market is currently within a downward momentum. It is still below the Ichimoku cloud in terms of resistances. You can look at the pivot level at 67 cents and then 67.50, where the support resistance one for the week is going to be for the Aussie USD. In terms of support to the downside and potential target, if you're shorting Aussie USD, would be 0.66, 0.6550, and ultimately at 65 cents for the Aussie USD. Right? EURUSD here on Tuesday at time of recording. This one here is a little bit unique because it went back inside that range 1.0850 to 1.09. The overall tone for this one, if you take a look at the stochastics, we do see the momentum about to correct itself. So the overall tone for this one here, the ideal situation would be a break below 1.0850, and we see a little bit of a correction to the downside, ideally towards 1.0750 and not lower than 1.07. We any bounces from 1.07 or 1.0750, that would signify that in terms of the pullback, there's a little bit more of a correction. So the ongoing uptrend will likely resume. Again, the limits would be at about 1.07. Don't really want to see a close below 1.07, because any close below 1.07 would transition to a deeper correction that could lead to 1.0650, and that's going to make this a little bit tougher to get back to 1.1 on the EURUSD. However, if it does break 1.09, then yes, we might actually get that move towards 1.1 and 1.11 on the EURUSD. But again, the ideal scenario would be that correction to happen, because this is more in line with what the dollar index is showing as well, right? Pound USD, similar scenario. We do have a strong support coming in at 1.23, so anticipate a little bit more of a correction. Right now, we are opening the week below the pivot level. This is below 1.24. So immediate resistance, if you're trading intraday, would be 1.24, followed by 1.2450, and then 1.25. But the ideal scenario again would be a pullback towards 1.23. You might see a little bit of a dip lower. If we break below 1.23, not to worry. We still have an okay correction towards 1.22 and 1.2150. The key level would be 1.2150. We don't really want to see price transition below 1.2150, because then it would lose a lot of the momentum for any uptrend to continue, right? So this one here, we're categorizing the EURUSD and Pound USD to be more within a correctional phase. Likewise with the dollar Japanese yen, in terms of the correction, this one here has gone a little bit faster. This is likely going to be traded within the Ichimoku cloud, and there's going to be limits. Right now, at time of recording, the limit is actually at 133.50. We might actually see another attempt at 134.50. Again, very similar to the outlook last week, is for as long as we are trading above 132.50, we might actually see a stronger US dollar, and especially with the dollar Japanese yen as well. So the limits for this one, resistance 133.50, 134.50. Any break above 134.50, then that opens up a lot of opportunities to the upside. We've got 135, 137 on the dollar Japanese yen. All right. Next up is gold. Let's talk a little bit about gold, because a lot of people are focusing on gold because of that job opening numbers. It take gold above 2,000, kind of pushed up really high, and then it kind of fizzles out, right? We don't really see a lot of things building up for this one. Just a little bit of a warning here. What I'm detecting on the daily time frame for gold is that there is actually a class A bearish divergence, a regular bearish divergence, which is more of a potential reversal pattern, right? And psychologically, if we think about it, the historical high is actually at 2,075, and this is about July 2020, which is at the peak of the pandemic. So that was the high at 2075, and if the Fed is going to be hiking interest rate again, then it doesn't really make gold shine. And if we're talking about the banking situation, it's pretty much really under control right now. So There's no reason for a safe haven run, I guess, for gold. And in terms of the US economy, data was mixed. I think the panic happened because people were focused on what's going on. The banking system is failing, and then all of a sudden we've got a barrage of bad US numbers. But if we take a look at the numbers in the past 3-4 months, the US economy is actually doing okay. So it's really more of a panic run for safe haven. We just don't see that happening right now. And if we have the higher CPI numbers, or CPI not really meeting the consensus at 5.2%, then we could actually see that drop in gold happening. Now, in terms of support for gold, we do have a few support. Immediate support would be at 1980, 1960, and then 1950. Those are going to be your 3 support levels. In terms of resistances to the upside, you got 2020, 2040, and 2050. I'm not really expecting a run towards 2075, or maybe creating a new historical high, because we just don't have that environment as well, right? And also with the gold on the daily time frame, not only that it has a class A bearish divergence, it's actually kind of forming a rising wedge as well. So any break below 1980 could trigger a little bit more of a sell-off. So the overall tone for this one here, sure, it's still above the Ichimoku cloud, but the overall tone for this one here, this is a little bit oversold in my opinion. Overbought in my opinion. So I think a correction, it's kind of healthy, but in terms of the how big that correction is, it's going to be a huge correction, and a lot of people are probably going to be thinking, hey, this could be a sell-off because the correction is so huge. That could be the case as well. So this one here, it's rather volatile because we are at a historical high, so be mindful when you're trading gold. All right, and the last one would be oil. All right, we also have that OPEC announcement, which I forgot to mention at the beginning of the session, with the supply output cut of 1.16 million barrels per day. That's a significant cut, and we saw oil jumped up about $5 on the back of that news, right? So it takes oil from about 75 to about 80, 81, and it kind of just stayed there, right? We don't actually see any follow through. Now, there are a few reasons to why we're not looking at that follow throughs, because a lot of people missed out on the opportunity, right? If you jumped in at about 60, 67, 68, 70 level, then yeah, you would be in for that run. But what we're looking at is that a lot of people missed out on this run, missed out on this sudden announcement, because it happened pretty much Monday morning Asian session, at the very beginning of the session, right? And this is very unlikely for OPEC to announce it on a Sunday, I guess Sunday, Monday, right? So a lot of people miss out on the opportunity. And if we take a look at this one here, we're not really looking at any sell-off either. So people are not actually profit taking. So it's kind of stuck, right? And with the market being a thin market, it was holiday season and all that, we don't actually see a lot of actions. Now, there are a few reasons for this. Obviously, one, people are not doing any profit taking. So people are still expecting price to go up. There are going to be 2 types of buyers in the market right now. One that's likely going to buy in on a break above 82, and one that's waiting for a little bit of a pullback, right? They want a cheaper price at about 77, 78. So if we could build a base at about 77 to 78, then yes, we might actually see buyers come in at about 77, 78. So right now, it is not a great time to jump in long on oil, because you don't have buyers coming into the market. You're only going to get that when price breaks above 82, or price pulls back to about 70, 76, 77, 78 level, right? Those are going to be your key levels. In terms of the 10 bars that I've highlighted, that's going to take you up until about the 17th or 18th of April. That's where the Ichimoku cloud is thin. So we need to see that pullback happen. Otherwise, we're not going to get buyers in the market, and oil price is not going to go anywhere. So in terms of supply cut, is that going to drive oil higher in the future? Theoretically, yes, right? But just from a more on the pricing, it's just not the right pricing. We're just not gonna get any attraction from buyers at this current level. So we either need to see a little bit of a pullback or a break above 82. All right, so this was a pretty long outlook for this week, but there's a lot of things to discuss. So yeah, good luck with the trades, and I'll see you very soon.